In 1975, Kodak invented the digital camera, a groundbreaking innovation. Yet, by 2012, the company filed for Chapter 11 bankruptcy protection. Despite pioneering digital photography, Kodak struggled to transition from film, losing its market position to competitors like Canon and Sony. What led Kodak to fall behind in the digital age it helped create? Kodak, once a titan in the photography industry, faced a pivotal moment in the early 2000s. Despite its pioneering role in digital photography, the company struggled to adapt to the rapidly changing market. The onset of digital photography eroded demand for traditional film, a core component of Kodak's business. By 2012, Kodak's financial situation was dire. The company reported assets of $5.1 billion against debts of $6.8 billion. These figures underscored the pressing need for restructuring. Kodak's cash and short-term investments amounted to $900 million, insufficient to cover its substantial debt. This financial imbalance forced Kodak to file for Chapter 11 bankruptcy protection in January 2012. The competitive landscape was also shifting. Foreign competitors such as Fujifilm undercut Kodak's prices. Canon and Sony made significant gains in digital camera sales, further eroding Kodak's market share. Kodak's focus on high-end, niche markets did not yield the financial turnaround it needed. Attempts to diversify its chemical operations also failed to stabilize its finances. During this period, Kodak announced plans to sell its film, commercial scanner, and kiosk divisions. The company aimed to raise $3 billion by slashing shareholder payouts. This move highlighted the desperate measures Kodak took to maintain liquidity. In 2003, Kodak reduced its workforce by 47,000, a core indication of the restructuring costs and recessionary forces impacting its operations. Despite these efforts, Kodak's late entry into the digital camera market and its inability to capitalize on its own innovation left it struggling. The stakes were high, with Kodak's very survival hanging in the balance. In the late 20th century, Kodak stood at the forefront of photographic innovation. The company's invention of the digital camera in 1975 was a landmark achievement. However, the initial hesitation to fully embrace this technology set the stage for future challenges. Kodak's early digital imaging offering, Photo CD, launched in 1991, showcased the company's potential in digital spaces. By 1996, Kodak released the pocket-sized DC-20, marking its entry into the consumer digital camera market. Kodak's Easy Share line, launched in 2001, was another significant step. This product aimed to simplify digital photography for consumers, making it easier to share images. Kodak's investment in digital imaging research was substantial, reaching $5 billion. This investment demonstrated Kodak's commitment to digital innovation, even as it struggled to transition fully from its traditional film products. Despite these efforts, Kodak's strategic decisions during the early 2000s reflected a company grappling with its identity. In 2003, Kodak announced it would halt investing in traditional film products, a move that signaled a shift in focus. Yet this decision came amidst a backdrop of increasing competition and declining demand for film. The company's plan to ditch traditional cameras for new digital products was ambitious, with projections of $1 billion in cost savings. The competitive landscape was intense. Fujifilm, Canon, and Sony were rapidly advancing in digital technologies, capturing market share that Kodak had once dominated. Kodak's attempt to navigate this environment included a controversial decision to slash shareholder payouts to raise $3 billion. This move was part of a broader strategy to stabilize finances and invest in digital transformation. In 2007, Kodak sold its health imaging business for $2.35 billion, further indicating a shift away from its traditional operations. The sale was a strategic maneuver to free up resources and focus on digital and commercial printing technologies. Kodak's restructuring was evident in its decision to close 13 manufacturing plants and 130 processing labs, a response to declining film sales and the need to streamline operations. By 2011, Kodak contributed $245 million to its United States pension obligations, reflecting ongoing financial commitments amidst restructuring. The company also hired Lazard to sell its digital imaging patents, highlighting the value Kodak still held in its technological innovations. Despite emerging from bankruptcy in 2013, Kodak's struggle to adapt to an increasingly digital world was apparent. The company's decision to focus on commercial packaging and printing products marked a new chapter. Kodak's legacy in digital innovation was undeniable, yet its rise was marred by strategic missteps and an inability to fully capitalize on its groundbreaking inventions. The story of Kodak's rise is one of innovation, ambition, and the complex dynamics of a rapidly evolving industry. In January 2012, Kodak filed for Chapter 11 bankruptcy protection. This marked a critical turning point, a moment of reckoning for the company that had once been synonymous with photography. The filing was not just a financial maneuver. It symbolized Kodak's struggle to redefine itself in a digital age that it had helped to create. At the time of bankruptcy, Kodak's financial landscape was stark. The company reported assets of $5.1 billion against debts totaling $6.8 billion. This imbalance highlighted the financial strain Kodak faced as it attempted to transition from film to digital. In a bid to stabilize, Kodak secured a $950 million loan to support its operations during the restructuring process. The decision to file for bankruptcy was accompanied by significant corporate restructuring. Kodak announced plans to sell its film, commercial scanner, and kiosk divisions. This was a strategic effort to shed unprofitable segments and refocus on core strengths. The company aimed to emerge leaner and more competitive, targeting growth in commercial printing and packaging. Amidst these changes, Kodak's commitment to digital innovation remained evident. The company hired Lazard to sell its digital imaging patents, seeking to leverage its technological assets. This move underscored Kodak's ongoing belief in the value of its intellectual property, despite its financial challenges. The bankruptcy filing also prompted Kodak to address its legacy liabilities. The company made a $245 million contribution to its United States pension obligations, demonstrating a commitment to meeting its financial responsibilities even in difficult times. As Kodak navigated the bankruptcy process, it faced the challenge of rebuilding its brand and market position. The decision to emerge from bankruptcy in September 2013 marked a new beginning. Kodak had shed significant liabilities, but the road ahead was uncertain. The company's pivot away from consumer markets towards commercial products was a bold step. It reflected a strategic decision to capitalize on emerging opportunities in packaging and printing. Yet this shift also meant leaving behind the consumer photography market that Kodak had once dominated. Kodak's story at this turning point was one of reinvention. The company sought to redefine its identity in a world moving rapidly towards digital solutions. The question remained, could Kodak leverage its legacy of innovation to secure a successful future? As Kodak emerged from bankruptcy in September 2013, it faced a transformed landscape. The company's market share in digital cameras had significantly eroded. Competitors like Canon and Sony had firmly established their dominance. Kodak's decision to stop selling digital cameras and focus on commercial markets was a strategic pivot. Yet, it underscored the challenges Kodak faced in regaining its footing. The financial results post-bankruptcy painted a complex picture. Kodak reported fourth-quarter net profits of $19 million. However, this was set against sales in the quarter amounting to $3.78 billion, indicating a need for more robust profitability. The restructuring process led to the closure of 13 manufacturing plants and 130 processing labs, a significant contraction of Kodak's physical footprint. The company's attempts to sell its digital imaging patents highlighted its struggle to capitalize on its technological innovations. Despite Kodak's early leadership in digital imaging, the market had moved swiftly. The late entry into the digital camera market had cost Kodak dearly, as was reflected in its declining sales starting in 2008. In an effort to stabilize, Kodak controversially slashed its shareholder payouts to raise $3 billion. This move was part of a broader strategy to improve liquidity amidst restructuring costs and recessionary pressures. Kodak's focus shifted towards high-end niche markets in commercial packaging and printing. This represented a departure from its traditional consumer base. By 2020, Kodak announced plans to produce pharmaceutical materials in response to COVID-19. This diversification into new sectors demonstrated Kodak's ongoing efforts to adapt and find new revenue streams. However, the success of such initiatives remained to be seen. In 2024, Kodak Alaris, a subsidiary, was sold by the UK PPF to Kingswood Capital Management. This transaction was part of Kodak's continued efforts to streamline operations and focus on core business areas. The sale of Kodak Alaris marked another step in Kodak's long journey of reinvention. Kodak's story, post-bankruptcy, is one of continuous adaptation. The company has sought to redefine its role in a digital world it once helped to shape. The question persists. Can Kodak leverage its legacy to forge a sustainable future? The narrative of Kodak's reinvention remains an ongoing chapter in the annals of business history. Kodak's journey from a pioneer of digital photography to a company grappling with reinvention offers crucial lessons in business adaptability. Despite inventing the digital camera in 1975, Kodak struggled to capitalize on its innovation. The company's late entry into the digital market allowed competitors like Canon and Sony to seize market share. Kodak's experience underscores the importance of timely adaptation in rapidly evolving industries. The shift from film to digital photography was a seismic change that Kodak underestimated. This miscalculation led to its bankruptcy in 2012, illustrating the risks of clinging to legacy products in the face of disruptive innovation. The economic impact of Kodak's decline was significant, with the closure of 13 manufacturing plants and 130 processing labs. This contraction not only affected Kodak, but also had broader implications for local economies dependent on these facilities. The restructuring costs and recessionary forces further strained Kodak's liquidity, prompting controversial financial strategies like slashing shareholder payouts. Kodak's pivot towards commercial markets and niche sectors highlights the necessity for businesses to continually reassess their strategic focus. The company's ongoing efforts to diversify, including ventures into pharmaceutical materials, reflect a broader lesson on the need for agility and foresight in business strategy. Kodak's story remains a cautionary tale about the perils of complacency in the face of technological progress. Kodak's journey reveals a profound lesson. Inventing the future is not enough without strategic execution. The company's failure to transition from film to digital photography underscores the dangers of hesitating in the face of technological shifts. While Kodak once led the way in innovation, its reluctance to embrace change allowed competitors to dominate. This misstep led to Kodak's bankruptcy in 2012 and a subsequent struggle for relevance. As Kodak continues to redefine itself, its story stands as a testament to the critical need for agility in business. The enduring question remains, will Kodak's reinvention secure its legacy? Stay informed as this narrative unfolds.